Right. Welcome to our session, ladies and gentlemen. First of all, I would like to apologize for shifting you guys, but temporarily I have to work with you. I think there will be an earlier slot, but that class is about to finish. I will tell you when it's done. Then I can move you to that earlier slot. But for now, we just have to work with the Thursday and Friday slot. So I'll be telling you how we'll be dealing, but if I don't say anything that they know that it's Thursday, then it's either Thursday or Friday. But Thursday for this week and next week it will be Thursday. But I think for next week we would need another extra. I will have to force another extra lesson during the weekend so that we can be able to push some things which I want us to push before you write your test. So that means we will next week we are likely to meet twice. So I will have to do the one on Thursday and then another one during the weekend. Right, in this session for now, it's a combined class with some guys who don't do the individual capital gains. So for now, I will concentrate on the capital gains of businesses. Then the individuals, I will do them at a time to be arranged. Right. So today we're going to look at capital gains tax. So our focus will be on capital gains tax. Capital gains tax. Right. Capital gains tax. It's a tax that was introduced on 1 October 2001. So it was introduced on 1 October 2001. This date is important because why I have mentioned it in the notes, because there will be a time that we'll be talking about. It will be saying if the asset was bought before 2001, if the asset was bought after 2001. So that's why we're mentioning the date so that you know why it is important. It is important because before 2001, capital gains were not taxed. They only started to be taxed as from 1 October 2001. So as such, any capital gains earned before 1 October 2001 will not be included in the taxable income. Right. You should also note that a CGT. Okay, let me just write CGT so that next time when you see me writing CGT, you should know that we're talking about capital gains tax. Right. This is not a separate tax. But it is part of income tax. So it's unlike those other tax like transfer duty tax and stuff like that, which are separate taxes. This one is just part of the Income Tax Act. So at the end of the day, after determining your capital gain, it would then be included in your normal income tax payable. All right. To determine capital gains tax, we have 4 building blocks. What they call 4 building blocks, which have to be determined. Number 1, there should be an asset. Number 2, there should be disposal of the asset. Number 3, there should be a base cost of that asset. Number 4, we should have proceeds from the disposal of the asset. So those are the things that will be determining as we try to determine our CGT. So today I will look at some of the, I'll be mainly be dealing with the theory part of it. Then some of the things I would ask you to read so that we can be able to push. Then next week we'll then be doing the determination of the capital gains tax. Right. first of all, we first have to determine when there's a disposal, whether it forms part of the capital gains tax or not. So now to determine whether an asset falls under capital gains tax, we have to go back to what we did when we were defining gross income. If we still remember, we said gross income, it's an amount received or accrued to or in favor of a resident. In the case of a resident, income from anywhere. In the case of non-resident, that is received in South Africa. And we said that it should not be of a capital nature. It should not be of a capital nature. So those cases that we're dealing with that time when determining whether an amount is of a capital nature or not. So if an amount is of a revenue nature, then it will not be subject to capital gains tax. But if it's of a capital nature, then it will be subject to capital gains tax. So the one that is a capital in nature will be subject to capital gains tax. So we have to go back to those cases like those ones of the tree and the fruit when determining whether it's of a capital nature or not. Right. So to determine whether a disposal involves CGT or not, we should determine whether the proceeds from the disposal are of a revenue or are of a capital nature. Right, so we have to determine then we're saying in terms of case law, objective and subjective factors. If you go back to our previous topics, we remember that we had objective factors and subjective factors that we can use to determine whether a receipt is of a capital nature or not. Right. So if a receipt is determined of a revenue nature, then there will be no CGT. But if it is of a capital nature, then there may be CGT determination. I'm saying there may be because we're going to learn of situations whereby the process may be of a capital nature, but we won't take into account the CGT. Right. Then we look at the persons that are liable for CGT. Right. You would find that a person, the eighth schedule, which we normally use when determining the CGT, it refers to a person, not a taxpayer. So that means every person can be subject to CGT. So I think every person can be subject to CGT. Right. And for residents, they are liable for CGT on capital gains from anywhere. So that means if a South African resident, if you get capital gains in France, you have to declare them here in South Africa. If you make capital gains in Australia, you have to declare them here in South Africa. Remember that the tax regime of South Africa, you are taxed on a residence basis. So all your capital gains, whether they are made here or outside South Africa, you'll be liable for a CGT. Then non-residence tax. Non-residents. For non-residents, it's different. If they have capital gains from their assets outside South Africa, they will not be liable. They will not be required to declare them here in South Africa. They will only be liable for property that is connected to South Africa. All right. They are only liable for CGT on the following assets. Right. Immovable property situated in South Africa. So if there you are a non-resident and you sell a property which is here in South Africa, then you can be liable for CGT. Right. Then we have got interest or rights. Rights to or in immovable property. In South Africa. Any assets effectively connected with a permanent establishment of the non-resident in South Africa. For example, he may be operating a business here in South Africa. So the fact that he's a non-resident, you will still be liable for capital gains tax. So you should know that for a South African, you will be liable for all your capital gains, whereas for a non-resident, you will only be liable for capital gains connected to South Africa, connected to property within South Africa. Capital gains are only taxed on assets because of on or after 1 October 2001. So if an asset was disposed of before 2001, then it will not be liable for CGT. So for a property to be liable for CGT, it should have been sold after 1 October 2001. Remember, we said there was no CGT before then. Right. Right. So there is a capital gain when the proceeds from the disposal are more than the base cost. So we're going to talk about the, but now the proceeds is not just the right. We're not talking about when it was bought, it's when it was sold. So if it was bought before 1 October 2001, but it was sold after 1 October, then it can be subject to CGT. But the gains that will be subject to CGT are only the gains from 1 October going forward. Any gains that were made prior to 1 October will not be subject to CGT. So we're talking about the sale here. So only gains made from 1 October. So if you bought an asset, let's say in 1990 for 100,000, then by 1 October 2001, it had a value of 1 million. The gain from 100,000 to 1 million, it will not be taxable. But the gain that you made, let's say now, it is now moved from that 1 million to 1.8. That additional 800,000 will be the one that will be subject for CGT. So we're saying capital gains tax will only be liable on capital gains that were made from 1 October 2001 going forward, regardless of when the asset was bought. So that means the gain up to 1 October 2001 will not be included. We will only include the gain after 1 October 2001. Right. Then when the asset, the proceeds are less than the base cost, there is a capital loss. But you should remember, a capital gain, you include it in your taxable income. But of course, we're going to talk about the percentages. It's not all the capital gain that will be included in taxable income. Right. But if you have got a loss, you cannot deduct it when determining your tax. If you have got a capital loss, you carry it forward to the next year. Then the next year, if you make capital gains, that capital loss can be utilized on those capital gains so that will not be taxed there. Right. So normally, when we are determining capital gains, we start with the calculate the capital gain for all the assets one by one that were disposed of during the year. After getting the capital gains, we add them up, then subtract any capital losses that were made on other assets. Right. So then after like, okay, let me just give you the framework so that you can be able to follow what I'm saying here. Right. So we'll say capital gains for individual assets. We call it the gross capital gain. Right. We add them together. If there are 10 assets, you add them together, or the 10 assets. Right. Then you get you then subtract capital loss on individual assets. There can be some assets whereby the base cost was more than the proceeds. Then you have to take out that loss. After taking it out, we get what is called net capital gain for the year. And it can be a loss. If it's a loss, it will be carried forward next year. Right. After getting a net capital gain, you can also subtract your assessed capital gains, losses brought forward. So that means these ones are coming from last year. So if you've got any gain, if you made a capital loss last year, you can be able to deduct it from your capital gains this year. Right, then you get your taxable capital gain. Right, our taxable capital gain. Right, then when we get your capital gain for companies, which is what I'll be dealing with for now, only 80% of the capital gain will be added to taxable income. So that's what we say when we say the 80% inclusion rate. Income capital gains is not a separate tax. So after getting your capital gains, you calculate your 80%. That 80% is what you add to your taxable income. You are going to learn, those who are doing tax 3761, you learn that for individuals, the rate is 40%. It is different from 80. So this one, it's for companies. Of course, as I said, for now, I'm not going to deal with the individuals. I will deal with them at a later stage. Right. So if you have got a loss, if you have got an assessed loss, as I said, you don't deduct it from your taxable income. Any loss, you are supposed to carry it forward to next year. It can only be deducted against capital gains that will be made in future, not against other income, only against capital gains. Right. Right. On the 4 building blocks, we said for there to be a capital gain, there should be an asset. Right. Now, when we talk about assets, according to the definition, you should note that it doesn't only include capital assets, it includes capital and non-capital assets. So this refers to property of any nature. Whether movable or immovable. Corporeal or incorporeal. So we're saying we don't necessarily have to have a movable or an immovable item. So please note that when we talk about capital gains, we are not strictly talking about non-current assets. Right. It also includes a right or an interest. Of any nature. Such property. Let's say you share the husband and wife share property. Your part of the right will also be part of the what? It will be an asset. So any asset can be included here. We can include furniture, motor vehicles, even inventory. Right. Then they will determine if there is a capital gains. But remember that if we are talking about things like inventory, we have to check if the proceeds were included in income. Remember that an amount, if it's included in income, the normal income, then it doesn't have to be included in the in CGT. Right. Then if it's an asset, so the first thing it has to be an asset. That's the first building block. The second building block is there should be a disposal. Right. For a transaction to be subject to CGT, there must be a disposal, or what is called deemed disposal. When we say deemed, from the look of things, from the literal and day-to-day focus, it appears as if it's not a cell, but then it will be regarded as a cell for tax purposes. So we're going to learn about which ones are the deemed disposals and which ones are not deemed to be disposals. Right. Other disposals, we'll talk about what we call a disposal event. Right. A disposal will take place when there is an event X appearance or operation of law resulting in the creation, variation, transfer, or extinction of an asset. Right. And can include some of the following. I'll just be please note that the ones that I'm putting here are not all that are stated in the act. I'll just give you some of them. Then at your own time, you can try to get maybe your recommended text so that you can see what these are. Right. They are in the act actually. Sell, donation. So if we sell, it's very obvious. Donation. So you find that there are issues of tax avoidance. So conversion, granting, cession, exchange, or any other alienation or transfer of ownership of property. So if you donate, there can be a disposal. If you sell, there can be a disposal. If maybe they are being compensated by the government for your land, that will be disposal. If your car has an accident, you get your what? Your insurance. That can also be a disposal. Right. Forfeiture, abandonment, cancellation, surrender of an asset. All these will be regarded as a disposal. Scraping, loss or destruction of assets. Maybe it's destroyed by a fire. It can be deemed to be a disposal. Right. Vesting. Interest. Interest assets. Distribution of an asset by a company to a holder of shares. So if a company gives a shareholder an asset, that will be taken as a disposal. Granting, renewal, extension, or exercising an option. Right. Decrease of a person's interest in a company. That also applies to a trust or even a partnership. So all these will be regarded as a disposal. So if this event happens, we have to check if there's a capital gain or a capital loss. And if there's a capital gain, then we have to include the 80% portion in the taxable income of the company. Right. Then at your own time, I want you to look at what are called non-disposals. I want you to look at what are called non-disposals at your own time. Just check what are called non-disposals in your study guide. Right. Then we have got what we call deemed disposals. That means from the nature of the transaction, it appears as if there is no disposal, but SARS will take it as if there's a disposal. Right. There will be a deemed disposal when a person commences to be a resident. The moment you become a resident, then there can be a deemed disposal. So they will now be, remember that they will now be subject to capital gains tax from that moment that they become a resident. So when you become a resident, you will be taken as if you have disposed of all your assets and you will have reacquired them at a cost equal to the market value. Right. So you will be taken as if you have disposed your assets. You are now a new person coming into a new regime. But of course, that does not apply to a property that is situated in South Africa. Right. A person to be a resident. So it also applies if a person ceases to be a resident. Then there will be, you'll be have taken to have disposed of all your assets at their market value. Right. Foreign company. commences as controlled foreign company. Right. Let's say a local company acquires a foreign company and acquires the majority of the shares to the extent that it starts to control that other company. So the company will have will be considered to have disposed of their assets at prices that are equal to market value. Right. The same way, a foreign controlled entity ceases to be a foreign controlled entity. So just like a non-resident, when someone becomes non-resident or ceases to be non-resident, the same with a foreign-owned company. When it becomes a controlled company, then there's a disposal. And again, when it ceases to be a controlled company, it will be regarded to be a gain or a capital gain also. Right. Right. Foreign controlled company becomes a resident. A company that was controlled, let's say it was a foreign company, then suddenly it becomes a local company. Right. Right. I think there are some other deemed disposals that I will not look at, which mainly looks at individuals, but we'll look at them at a later stage. And you should know that a personal use asset, we don't consider a CGT on personal use assets. For example, if you've got your television that you use at your home, then it will not be considered to be it will not be considered to be part of the CGT. Right. Base cost. Right. What is base cost? Remember, we said that for there to be capital gain, we should have proceeds that are more than the base cost. Right. It will depend. For assets acquired before 1 October 2001. Right. It will be the value on 1 October 2001 plus any expenditure incurred after 1 October 2001. Let's say, for example, the value in 2001 was 10 million, but then in 2006 we did an improvement on the asset of 1 million. So the base cost will now be 11 million. Right. Then for an asset bought after 1 October 2001, that's our expenditure incurred in acquiring the asset. So you should know that for most of the expenses, we just do like what you do in accounting, whereby you take the cost, any transport you add it, any installation you also add. The same procedure is also followed. Right. Then so I'll also ask you to maybe go in your recommended text and then check if there's a whole list, a lot of items that are included as part of the cost of the asset. You should note that there are other special expenses. For example, the cost of finding a buyer to buy the asset when you are selling it, the any sales commission that you will have to pay. They are also considered to be direct costs of disposing an asset. So unlike accounting, whereby in the cost we only include the cost of buying, so even selling costs when you are trying to sell them, the asset, they are also included as part of your base cost. So if you have got any commission that you paid for someone who is selling your asset, if you've got moving costs to move your assets to the way you're going to sell it, all those things will be included. So the direct cost of acquiring and the direct cost of disposing the asset will be included in the cost of the asset. So all those costs, even improvements, they will also be included in the cost of the asset. So, okay, maybe let me just write, we normally include acquisition or construction costs. Remember that some companies, they construct their assets. Direct costs incurred in acquiring the asset. So any direct costs that were incurred to acquire, to buy the asset. Then we also include direct costs incurred in selling the assets. So also includes the direct costs incurred in selling the asset. Right. So again, I would also to like you to check the expenditures that are included in base costs, and there are also some costs which will then be deducted. For example, if you've got any costs that you included which you later recovered, they will not be included in base cost. Then we shall also know that if there are capital allowances, when you talk about base cost, we'll also take into account the recoupment. Right. So I will show you through the questions when we do them next week. Right. Then you should know that normally for an asset that was acquired prior to 1 October 2001, we normally use there are items that I would like you to try to look at so that you can be able to see if you can get them. Right. So we're saying normally for assets acquired before 1 October 2001, we have to determine what we call the valuation date value. We have to calculate what is our value of that asset on the date on 1 October 2001. Right. So now to determine our cost on 1 October 2001, we normally use what we call the usually the higher of right. We have got what we call the market value. Then we've got what we call the time apportionment, base cost. Then we have got what we call the value according to the 20% rule. That is 20% of the proceeds. So you'd find that usually would take the higher of the three, but there will be rules whereby maybe you might find that we don't consider the market value, or we don't consider any one of those items. So we're going to deal with those rules as we deal with the questions. So you have to check is what was my asset bought in 2001, or it was bought after 1 October 2001, is that will have a heavy bearing in the determination of the value of that asset. Right. So we should also be able to, although they don't examine as much on that, we should also be able to determine the time of portion, I mean, base, the market value normally are given. Right. Then we should also have proceeds. Right. For there to be capital gains, there should be proceeds. And these proceeds should be more than the what? The base cost. So I think for there to be PGT, it should be a disposal of an asset. Either be a disposal or deemed disposal. Right. And PGT will be the difference of base cost and the proceeds. Hence, we are talking about this part here. Because for us to say there's a capital gain, we have to compare the proceeds to the base cost. That's why we are talking about this part, which relates to the base cost. Right. Proceeds refer to amounts received or accrued to. Or in favor of a person, and can include amounts by which a person's debt is reduced. Due to an asset. So let's say you owe me 5,000, and then you give me a laptop instead. So we can refer to by how much is your debt gone down? All right. Amount received or accrued to LSC from lessor for improvements effected on the property. I think when we did the other topic, we learned that there can be what we call obligatory lease improvements, whereby the lessee is required according to the contract to make some improvements on the property of the lessor. So if there is any payment that will then come with regards to those improvements, and the lessee is paid some money, whatever the lessee is paid, that can also be considered to be proceeds. Right. The proceeds can be reduced by any amount included in gross income. Of the person before inclusion of taxable capital gain. So if there are amounts that had already been included in the taxable capital gain, then they will not be included. For example, recoupment. Remember recoupment from our previous topic. Where there are capital gains, our recoupment is the cost minus the tax base. So that portion, that recoupment will be included directly in taxable income. So when we are determining the proceeds, we should take out the portion that has been directly included in the taxable income. Right. Any amount refunded to the buyer during the year of assessment. So it can happen that after payments made by the buyer, then you might have to retain some amounts. Then they will also be reduced. All right. Reductions due to cancellation, termination, or variation of agreement. So it can so happen that maybe there are changes that are made to the original agreement. Right. Donations and transactions between related parties. So if you donate or there is a transaction involving a capital receipts between related parties. When we say related parties, it can be natural parties. That is a father and a son. It can also be artificial persons. For example, a parent company and a subsidiary company. So whenever, so if a person disposes an asset, for a consideration or don't that is less than the price at arm's length. When we say at arm's length, that means where it's be strictly business or a donation, a connected person. The proceeds will be the open market value. So if you sell to each other in a friendly transaction, let's say it's one of your company selling to another, then you'll be although you might sell 800,000, they will look at the open market value. If the open market value is higher, they will use the open market value, although you have sold 800,000. Let's say you have sold 800,000, but the open market value is 120. You will have, although you received 100,000, you will have, you'll be taxed as if you received the fair value or the open market value of 120,000. Right. Disposal proceeds not yet accrued. Right. Where proceeds do not accrue in the year of assessment. Any capital loss on such assets should be disregarded. Right. The losses will be set off against the gains. When the proceeds accrue. So that means maybe there's a condition. So if you the proceeds do not accrue in this particular year, and you see that when you are considering the proceeds that have already accrued, you find that there's a loss. As long as there are proceeds that are to come in future, those losses should not be considered when determining our net capital gain, but can be deducted in future when the proceeds accrue and they determine that there is actually a loss and a profit. Right. So my friends, I want you to go and read and see those things that I said, the disposals, the deemed disposals, and I want you to also know the costs that are included in base cost and the costs that are not included in base cost. So then next week, we will now be determining the capital gains of an asset. We should be able to determine the capital gains for assets bought after 1 October 2001 and the capital gains for assets bought before 1 October 2001, so that we can be able to determine the capital gains. First of all, we'll deal with capital gains of businesses. Then we'll then deal with the ones for individuals. I think if we get time during the weekend, we'll then do the individuals. Any questions? So please go through the principles so that you can be able to follow when you meet. Thank you so much and God bless you richly.